Welcome to Educational Alpha. I'm Bill Kelly, CEO of CIO Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly sits down with Mark Anson, CEO and CIO of Commonfund, to explore the evolution of the endowment model and its ongoing relevance in today's investment landscape. Mark shares his extensive experience from managing the California Public Employees Retirement System, CalPERS, to leading Commonfund, providing insights into private equity, the growth of interval funds, and the impact of generative AI on portfolio management. Listen in.
Mark Anson, welcome to Educational Alpha.
Thank you so much, Bill. Happy to be here.
My pleasure. And maybe unknowingly, our careers have intersected many times over the years. And as I think I've told you, way back when I was at the Boston company and you were at CalPERS, you were a client, although I was the CFO back then. Mid and back office was not a concern for investors, very much is today, and we're going to get more into that. And then more germane to this conversation, you were on the board of the CIO Association and a big catalyst as to why I joined in the first place, because you were somebody I knew of very well. And then when I finally did get a chance to spend some time with you, you absolutely convinced me on the value proposition of why education matters. So I thank you for all of that. But before we get into a lot, and not the least of which is your current station, maybe a little bit on your background. And it might take some time because you've had some awesome stations all over the world in some respects, but maybe just a quick recap of where Mark Anson has been in the course of his career.
Thank you, Bill. First, and it was a pleasure to hire you as Chief Executive of CIO. I remember that well when I sat on the board, and it's been a good run with you. So thank you for your service to CIO. My own background, I grew up on the trading desk of Wall Street. But what really jump-started my career was going to CalPERS, the California Public Employees Retirement System, and becoming the Chief Investment Officer of CalPERS. And that was a big change, moving from the East Coast and Wall Street to Sacramento and moving from the private markets to the public markets. It was a change that I took a leap of faith on and was well rewarded for it in terms of just opening up my eyes and in terms of managing a very large, sophisticated pool of capital. And then getting a much better sense of understanding of how do you manage a liability stream and how do you finance a liability stream. Some things that I never had thought of or had to think about or worry about when I was working on Wall Street. So working for CalPERS was a wonderful experience. I loved my time there. And despite what you read in the press, CalPERS is really a great organization to work for. Great people, smart people, hardworking, dedicated. Loved the time there. I then got the opportunity to take my pension fund skills and move them across the pond, so to speak, to the United Kingdom, and become the chief executive and the CIO for the British Telecom Pension Scheme, and did that for several years before coming back to the United States and becoming the president of Nuveen, the very large asset management company based out of Chicago, which was then merged later on with TIA. It's now called Nuveen, but it's sort of TIA Nuveen put together. Also had time managing the Bass family office. That's the billionaire family out of Fort Worth, Texas, with the patriarch Bob Bass. Again, very smart, sophisticated group of people, very thoughtful portfolio construction, very heavy emphasis on alternatives, particularly private capital. The Bass family invests quite a bit of their money in private equity, venture capital, private credit, et cetera. So a very thoughtful and thorough emphasis on alternative investments at the Bass family office. Today, I sit as the chief executive and CIO for the Commonfund. We manage about a little over $30 billion. We are the original OCIO provider out there. I know there's a lot of firms that claim that they're the original outsourced CIO provider. But we were actually founded in 1972 with a $2.5 million grant from the Ford Foundation. So if you think about that, go back 50 years ago, that's when we started, and the OCIO business model was born with 2.5 million of seed capital from the Ford Foundation. So go from 2.5 million to 30 plus billion today. I like to joke with Darren Walker from the Ford Foundation was probably the best investment the Ford Foundation ever made. And of course, he might differ on that opinion, but at least in my humble opinion, what a great story. It's also fascinating when you think who the original clients were with regard to the OCIO model or what was the birth of the endowment model. Yale, for instance, was one of our original clients long before David Swenson was hired. Commonfund was helping to manage the endowment for Yale, as well as a number of the other Ivy League schools. So again, that's very rich history to go back 50 years ago and say that's when the OCIO model was actually born, 1972. And Commonfund was managing the money for these well-known endowments before they became the well-known endowments.
It is great. And you've touched the lives of countless investors that may never know the name Mark Anson, but appreciate the service in many stations. So thank you for that. Although you left out the most important thing you've done in your career, being an author. And I remember you once saying to me that your wife asked you, Mark, will you ever write a book that people find interesting to read? And professionalism is not meant to be a page turner, but you did write the seminal curriculum textbook that was the foundational principles of the CHI Association. So maybe a bit on that, because it's meant a lot to many investors as well. And I don't think CHI would be where it is today without that original contribution.
I still publish a lot. I publish 2 to 3 research articles a year. Before we got on this official call, Bill and I were talking about my most recent paper, which talks a bit about our total portfolio approach. Maybe we'll touch on that in a bit. But when you think about it, there's a lot of people out there who claim to be thought leaders, but very few actually take the time to sit down and prove it by producing research and having a track record of research and innovation. But the fascinating thing is when you go back, why did I start doing this? What was the impetus? And back when I was a young guy sitting on the training desk and just beginning back then to get my certifications, first it was the CFA and then CAIA, I began to read more of the financial journals. And there were 3 people I looked up to way back then. One was Abby Joseph Cohen, the famous stock analyst from Goldman Sachs. Another was Peter Bernstein, was then Bernstein and Associates, now Alliance Bernstein. Another very smart guy was Marty Leibowitz from Salomon Brothers, who wrote the Yield Book. And I would pick up the Financial Analyst Journal or the Journal of Portfolio Management and be like, oh gosh, there's another article from Abby. And next month, there's another article from Peter. And the month after that, here's another one from Marty. And I realized that the really smart investors out there took the time to sit down and put their thoughts into words, and then they put those words out there by publishing them. And it's like writing a trade ticket. When you put your name on a trade ticket, there's no place to hide. If that trade does well, you get all the accolades and benefits from it. But if that trade turns against you, again, there's no place to hide. You get all the shame and blame for it. It's the same thing when you publish an article. It's like putting a trade ticket out there. If you write something really smart, people appreciate it. If you put something out there that's not so smart, people are going to criticize it. And those that really work on their investment credentials take the time to put their ideas out there, and they're willing to withstand the criticism they may get from that. That was the impetus for why I started to write. The CAIA book, which was Handbook of Alternative Assets, that's a funny story. So I was in that first cohort that sat for the original CAIA exam. This is going back 20 years ago. And back then, Bill, there was no textbook. It was just a bunch of articles you had to put together, and you read through all these individual articles, and that's how you prepared for the exam. I sit for the exam, I go through it, and then the CHI Association asked me, so Mark, what did you think? And I said something to the effect, well, gosh, great exam, and it was a thoughtful reading list of papers, but wouldn't it be nice if there was some book that would kind of summarize all this research for you? And I remember the response from the CHI Association at the time was, hey, Mark, great idea, have at it. Over the next year, I sat down and said, all right, let me take a shot at this. While I was still at CalPERS, it took about a year, a little over a year, to write that first edition of the handbook. But that's what I did, is I took all these research papers and then tried to summarize it in a coherent narrative for those that were studying for the next level of the exam. It turned out to be more successful than I ever thought. But as my wife, Mary, says, Mark, why can't you write a book that people actually want to read? And I just don't have that skill or talent to write something that interesting. I wish I did.
Maybe the sequel will be more of a page turner, but having gone through the curriculum myself very late in life and in my career, I did level 1 in March of 21 and level 2 in March of 22. Your DNA is still all over it. Those founding principles are in place, but like any curriculum, it has to evolve. And what defined institutional quality alts then and now, maybe from 30,000 feet is not all that different. And maybe this is a good segue to the endowment model. The premium on due diligence, operational investment due diligence, the risk profile, performance dispersion, these are all have changed dramatically over the last 20 some odd years for Kai, and then even more so over the last 50, almost 60 years of the endowment model. And maybe to put the founding principles with the Ford Foundation and the Commonfund in context, Mark, I just went back and reminded myself of this. You presented to our New York chapter a few years ago, I think when it was turning 50. And I went back and it was in the autumn of 1967 where an advisory board was formed. And this part I didn't know, but you probably do, that the head of the Ford Foundation was McGeorge Bundy, who was the national security advisor to JFK. So if you put it from that perspective, wow, a long time ago. And if you think about where private capital was back then, there were probably just a handful of GPs. And it truly was an alpha machine. But 60 years later, it's gotten more efficient, many more players coming into the mix. I think alpha is absolutely still there, but you have to work a hell of a lot harder to find it. And then the network effect of a big endowment or a common fund has a tremendous leg up, I believe, on the rest of the world. So maybe the current state of the union of the endowment model, and you can take the other side of it, but I would still argue it's not the alpha machine for the taking, it's the alpha machine for the studious investor that's taking the time to figure out where the opportunities are.
The endowment model still works. I know occasionally you might see an article, is the endowment model dead? And no, it's not. To your point, it's had to evolve. It has become more mature, which means a bit more efficient. To use your point, if you go back to 1980, there were less than 20 private equity firms in the world. Now there are over 7,500, probably more than that. So the private equity market, just by the sheer number of private equity managers out there, has become much more efficient. Going back to the early 1980s, basically all you had to do back then, if you were a private equity manager, was just show up with a bag of cash, take a company private, lever up its balance sheet, because back then leverage wasn't used to the extent it is today, and just reap the benefits of taking advantage of a levered balance sheet and using debt more efficiently. That's changed dramatically to where we are today in the private equity world. Today in the private equity world, it's not a matter of showing up with cash. There are literally thousands upon thousands of private equity firms out there that can do that. It's showing up, yes, with a bag of cash, but also with operational experience. So the best private equity managers out there tend to stay focused on just one or two industries, and they bring operational experience to the table now. That operational experience could be a better form of risk management, supply management, better management of the human capital, better distribution. If it's a franchise model, getting better financing for the franchisees. So today you have to show up, yes, with money, but also with something else. And that something else has to improve the overall operations and business model of the company you're buying. And the best firms that we see tend to be the small to mid-sized buyout firms. Again, those are the smaller firms that are operating in the small to medium-sized enterprises who are bringing both money and operational experience to these companies. And at least at Commonfund, we do tend to see a bigger bang for our private equity buck, focusing on those small to mid-sized private equity managers that are investing in those small to mid-sized companies where there is still a lot of operational efficiency that can be extracted from those companies. We tend to stay away from the very largest buyout managers, all the big brand names out there that you know. They're still wonderful big brand names, but again, we find more value with the small to mid-sized buyout firms that are investing in small to mid-sized buyout companies. And to that point, when we look at our own portfolio and we look, okay, the exits, how do you exit a private company? There are a number of ways to do that, but we're seeing about 50% of the exits from our common fund portfolio is what we would call a buyout to buyout sale. It's a small to medium-sized buyout shop selling one of their portfolio companies to a large buyout shop. So these are financial transactions. And we see that as a very large exit strategy for our small to medium-sized buyout shops selling to the bigger buyout shops. And that's one that we think adds value for our client portfolios.
A few very interesting points to follow up on. And a lot of this comes out of Bain's first half report, and a couple of interesting observations there. And I think, largely speaking, maybe in the large buyout space, the private equity model is very much around multiple expansion as opposed to margin improvement. And maybe in the buyout space, that still is the case. But I absolutely agree with you that I think in the SME space, or maybe more specifically middle market, you have a much better chance of having an operation team come in, work with management, and maybe get that margin expansion. So I didn't want to leave at least a response unsaid there. But also it was interesting, and I'd be curious to get your take in the middle market space. This Bain report or observations are probably more in the big buyout space. But if you look over the last, I think about 10 years, average number of portfolio companies has doubled. And I don't think the staff at these GPs has doubled as well. So now they're running around with a lot more responsibility, a lot less time. Have you seen that type of expansion inside of the portfolio in the middle market space?
Much less so in the middle market space. What we have seen is this expansion of private equity funds getting bigger and bigger and bigger. And that's another data point when we look at and are doing our own due diligence on a private equity manager. For instance, if they're on fund 3 or 4, what's been the growth trajectory? You see some buyout shops, you see them more as asset gatherers. They start with a $500 million fund, and then they go to a $1 billion fund, and then a $1 billion fund becomes a $2 billion fund, and a $2 billion fund becomes a $4 billion fund, and $4 billion, and so forth. We see that consistently, that some buyout shops just become asset gatherers. They just want to get bigger and bigger and bigger and bring in more and more. And the reason for that is you and I well know, Bill, and we know this from the Handbook of Alternative Assets, that 2% management fee early on, particularly for small to mid-sized buyout shops, that 2% management fee is really meant to cover the operating expenses of the firm, where you're using that to pay the salaries of your staff, using that for your travel, your due diligence costs. But for the large buyout shops, that 2% management fee definitely is a profit-driven management fee. And we see this because of the very largest buyout shops that have gone public. In order for them to maintain a reasonable multiple on their own public stock, they've got to generate a lot of management fees because those are valued much more highly than the incentive fees. For large buyout shops, the management fee definitely has become a profit driver as opposed to being just a cost covering fee. In the small to mid-sized buyout area, that 2% management fee or whatever it is still is meant to cover costs, and it's not there to drive profits. That's a very big difference that we see, and that's why we see this bifurcation, at least the way we look at the world at Commonfund. Not to pick on the large buyout shops, some of them are still very, very good, but we just don't believe that the management fee should be a profit driver, and we don't invest in the large buyout shops.
And I think that's a very good opening to democratization. I'm going to park that for one quick second, though, because I do want to ask you about exits, and you mentioned that as well. In the big buyout space, how are exits going? They're not, I think is the short answer. The plumbing is quite clogged, and we've had probably somewhere between $6 to $7 trillion raised over the last 5 years. So you need a bigger exit window to get that out the other side. And not only is the exit window not grown, it's been nailed shut to a very large degree. So we need the transaction side of this to turn back on. And I believe it eventually will. But we have, again, by Bain's estimates, $3 trillion across 26,000 portfolio companies. Average age is 4 to 5 years, so getting a little bit long in the tooth. That inventory is not going to all clear at NAV. And I think you got the LP on the other side. And you know this yourself and from your former day jobs that there's a liability side to that balance sheet. And there's a cash flow. Retirees need to be paid, and you can't pay them in capital calls. What's your outlook? And maybe this is not your hunt because you're in a different part of the space, but what's your outlook for the transactional side and that exit window, maybe more so in the buyout space?
There's a flip side to those large buyout shops not being able to exit their portfolio companies. That's going to lead to more secondary volume. At Commonfund, we have a very active secondaries team. We are quite aware that, as you said, the exit window has shrunk or, in fact, closed for some of the large buyout shops. That means they're limited partners and will be seeking liquidity. And if they can't get it from their general partner, they may end up selling their LP interests into the secondary markets. So we see this as a very good opportunity set for our secondaries team at Commonfund. And so we are aware of it, and we are, in fact, taking advantage of it. Or maybe a better way to say that is we're just mindful of the economic opportunity that presents itself as LPs are seeking liquidity that they're not getting from their general partners. So we view that as a good thing for our secondaries business. A third side of the coin, if there could be a third side of the coin, you're seeing more continuation vehicles out there. The GPs are stuck, so they're trying to provide liquidity themselves by forming fund of ones or fund of twos or funds of threes to buy some of their portfolio companies out of their existing private equity fund into their continuation vehicle to try and provide some liquidity there. We're also very active in that side of the market, again, primarily through our secondaries team, looking at these continuation vehicles to see if there's value there that we may want to buy into. But it will put pressure on these GPs to find some way to get liquidity back to their LPs. And again, at the very largest GP level, so the very large, the mega buyout shops, it's very hard to find another financial buyer to buy your portfolio companies. If you're a $20 billion buyout fund, who's going to be on the other side to buy a portfolio company from a $20 buyout fund? Most likely it's strategic, but less likely a financial buyer. Again, back to where we invest and operate in the small to mid-sized buyout shops, our GPs down there could sell to either a strategic or a financial buyer. They have more flexibility in their exit strategy. That exit strategy is less flexible the larger the fund size of the GP.
Liquidity never disappears. It gets repriced. And you may not like the price, but the trade will eventually clear when it finds its point of least resistance. And whether or not this is a good vintage year to come into a big fund, we can debate that. But I think your point is well taken, that if you're coming into the space for the first time, there's a lot of inefficiencies, which begets alpha if you do your homework. And I think this need for liquidity is exactly how Warren Buffett and Charlie Munger made so much money for their shareholders. They were liquidity providers at a time where the market was not all that liquid. So I think it's a good underscore that you put on the point. To jump back now to democratization, I wrote down your point around asset gathering with some of the large buyout shops. And that's their business model. And I'm a capitalist myself, and I don't besmirch them at all for that. But asset gathering is great for the shareholder, maybe not as great for the investor. It could be or it couldn't be. And we are now rapidly moving toward democratization. And if you look at virtually any piece of research that talks about the global AUM pie, the individual investor is now the dominant investor in the low 50s, but growing. And I can't remember the last time we minted a new sovereign wealth fund or a new defined benefit plan. So that part of the industry, albeit very slowly, is in secular decline. And the dominance of the retail investor is here to stay. Everybody gets this. On the one hand, myself being in Kaya's 401k plan, I don't like the options in front of me. They're pedestrian public equity, public debt offerings, when the home of capital formation is in the private markets. How do I get access to that? I deserve access as an investor, but do I have the right tools and am I equipped correctly to get there? And therein lies both the opportunity and the challenge. And if I'm just going to sign up for private equity as if it's an asset class, the dispersion is so wide. If I end up with the median return measured on IRR versus the time-weighted return in the S&P 500, I'm probably not doing any better than just paying a couple of basis points to Vanguard. So it is both a challenge and an opportunity. You and I were talking right before we came on about maybe why the endowment fund came into existence, and many reasons, but you have helped smaller endowments that don't have the wherewithal of the network effect and the buying power and access to GPs. You can commingle those assets and create something of value for the smaller endowment foundation. If I equate that to democratization, it'd be great if I had the retail version of Commonfund, where I could say, instead of me going to try to find the best middle markets manager or the best buyout shop, I can go someplace else and they can commingle my assets and help me help myself in my investment game. Maybe that's fantasy land, but you could take that in whatever direction you want. And democratization, I feel it's a mandate and we have to answer that bell. I'm less clear about how we're going to do it in a transparent and sustainable way.
The protection for the retail investor has always been instant liquidity. Long before we had T+1 in our trading on Wall Street, we had T+1 in mutual funds. From the very beginning of mutual funds, for open-end mutual funds, if you called up a mutual fund on a Tuesday and said, I want my money back, you got it on Wednesday. That has been the standard ever since mutual funds were invented back in the 1940s. So T+1, that very almost instantaneous liquidity has been a hallmark of mutual funds long before T+1 got to Wall Street. So that gives you a sense that mutual funds, in some sense, were massively ahead of the rest of the industry in terms of providing liquidity to the small retail investors. To invest in alternatives, you have to accept some amount of illiquidity. The endowment model has proven that. Whether it's the common fund endowment model or Yale or someone else's version of that, it was being a liquidity provider like Warren Buffett and Charlie Munger, willing to invest capital for long periods of time and not ask for that capital back. Again, very different from what we consider to be a retail investment product where retail investors can ask for the capital back the next day. So what's the wrapper that we put around this? And that's to first educate retail investors that if you want access to some of the things that Yale may have or Commonfund may have, you're going to have to accept some level of illiquidity to go with that. And that's where this idea of an interval fund was formed. For those listening to the call, an interval fund is still a mutual fund. It is what's considered to be an investment company, which is what you call a mutual fund under the SEC rules, or what is known as the Investment Company Act. It's just a different form of a mutual fund. And what it means simply is you allocate capital to a pool, just like a mutual fund, and it's managed by a central general partner or asset management company that's making the investments for you. But you only get to pull your money out at certain times during the year, hence the intervals. Those intervals could be quarterly, they could be semi-annually. And also the interval fund gets to put up a gate by saying we will only liquidate no more than 10% in any quarter. And that means if there's a rush for the door, you're not going to get all your money back. You'll only get a pro rata amount of your money back based on how many other investors are trying to get out of the fund. To democratize alternative assets, particularly private capital, and put it into some form of retail wrapper. Right now, the interval fund is the best model we have, or the best wrapper that we have to do that. And it does afford some amount of liquidity to retail investors, but at the same time, it forces on those retail investors a level of illiquidity. They cannot get all their money out at one time. And that's going to be an education process. And all the RIAs and wirehouses out there are going through that education process now. And indeed, we're seeing some of the largest buyout shops introducing interval funds themselves. And again, I'm not going to pick on any of them. I'm just pointing out that if you look at the top 10 largest buyout firms out there, I'd say probably half of them have some version of an interval fund that they're offering to retail investors.
Maybe it is the very best mousetrap and wrapper that we have. Is it perfect? No, but nothing in life is perfect. But can it be better? And I would like to think that it can. I think there's even a base level concept. I think most investors don't understand the difference between IRR and time weighted return. So with IRR, or money weighted return, the money's got to stay in the ground. And the moment it comes out to meet a tender, my IRR suffers. And I think therein lies a big part of the problem. Maybe it's hard and time consuming to explain the rationale for long-term investing, talking about the liability side of your balance sheet to an end investor. And it's easier to give them what they want, which is some form of liquidity. And the SEC would never clear the market with them. But if there was a bid-ask spread, and it was very punitive to get out. So to say to the investor, you can get out anytime you want, but you're going to pay a substantial discount because unless you're ready to come in for the long term, you shouldn't come in the first place. I know the mindset and regulation is not wired that way, but we've seen these studies Delbar has done in the public equity space, and they've done it in the target date funds as well. And the amount of basis points the average retail investor leaves on the table versus what the fund has done itself is enormous. And I think we've got to find ways of maybe looking at the target date fund, maybe as an opening bid, where that gap is actually almost non-existent because the investor puts that as money they're not going to touch for many, many years. And maybe the opening, and I think the DOL has provided a little bit of a shot for this, that maybe the opening is trying to institute a greater level of illiquidity, maybe in the target date fund space, or maybe we need to create a proxy for common fund for individual investors.
You raise the target date funds. It's amazing what the level of turnover is in a target date fund. Again, that's money that you're supposed to sock away and just set it and forget it and not touch or trade out of. The turnover on those products is still very high. And there was a research paper I published, I want to say about 10 years ago, when I looked at this, and the turnover rate at that point was 25%. That was 10 years ago. That's a very high turnover rate for a product you're supposed to set up and not touch. And this, I think, is the problem with all investors, but you see it more often than not with retail investors, which they'll say, yeah, I get the risk. I understand it. I'm fine with it. I'm okay. But the moment things go bad, they want their money back. And that is part of the difficulty that we struggle with, or the market struggles with a retail product. This is why for interval funds, you see them primarily now for private credit. Now, private credit is still a form of private capital, but it's a much shorter timeline, and there are cash flows that come out of that private credit right away because they're senior secured first lien loans or some form of asset-backed financing, but there's a cash flow stream right away. So the J curve is virtually non-existent. So we're seeing more and more of the interval funds to be primarily private credit right now and not the more illiquid private equity or venture capital yet. I expect we will see interval funds migrate more towards private equity and venture capital, but right now, the bulk of them are for private credit, where there is a cash flow coming out right away, which alleviates this difference between IRR and time weighted, because in that case, it feels more time weighted than IRR because you're getting cash flow immediately. Yes, there's still some illiquid appreciation associated with those loans because they're typically discounted or on some of the asset-backed financing. So there is some capital appreciation there that builds into an IRR. But still, right now, interval funds for private credit feel more time-weighted in terms of the return structure than IRR. And that's why you see the bulk of them there, and that's why they're appealing to retail investors.
The banks are not lending anymore anyway, so getting the access to yield where you probably have much less duration risk does make sense in the private space. And the interval fund, I think, has some applicability there. Maybe before we sign off, an emerging topic that is maybe less emerging to the common fund is generative AI and what that means in an investment process, what it means as an investment thesis in the innovation part of your portfolio. I know you've given this a lot of thought. You were an early investor in some of the more interesting ideas. So maybe talk about how you and the common fund think about the use of alt data, generative AI, and what it means for the future investor.
At a very basic level, we have direct equity stakes in ChatGPT and Anthropic and Hugging Face and a few of the other well-known generative AI products out there. Those are direct equity stakes into those companies. Right now, we're trying to learn. We're trying to put chips on the table where we think there's value to be added. And this is going through our venture portfolio. We are investing directly into some of these AI. At a broader level, it's fascinating to think about how AI might impact portfolio construction. I'll give you an example. I recently met with a very smart hedge fund based in New York City, and I'm trying to stay away from names of managers out there. But this hedge fund started using equilibrium models of the market, a CAPM model, a Black-Litterman model, for instance, an arbitrage pricing model, some equilibrium notion of the model upon which they built factor models, and that's how they allocated their capital. Over the last several years, they have migrated from an equilibrium model and then a factor model to an AI model, where they're just letting the data tell them where they should be in making their investments. So no longer are they making investments driven by some equilibrium model, economic model. It's a model purely based on the data coming through their generative AI models. So that's a very large change that this is just one hedge fund product that we're looking at, where they've gone from equilibrium, traditional, what we would call modern day finance models of the Harry Markowitz, the Bill Sharps, the Black-Littermans, to a completely generative AI model, which is just let the data speak for itself, and whatever patterns we find out there in the data, that's where we're going to invest, regardless whether there's some economic model supported or not. Fascinating transformation to see. And what they've done is they've tracked over the last 5 years the performance of their equilibrium models and their generative AI models. And it's clear the generative AI models are outperforming their equilibrium models.
As you think about that, interesting points, also getting back to the Kaya curriculum, overfitting in this space is a very, very big issue and challenge. And some of the criticism, generally speaking, about some of these new tools around generative AI is it doesn't have the reasoning and the logic and the intellectual history of the human being. It can take on tasks very well, but can it think sort of outside of the box? And how do you think about, as an investor, the concept and the concern about overfitting? And when you're doing due diligence on a model like this that might be a little bit more black than glass box, how does that affect your due diligence?
It's hard. You use the term overfitted. To say that a model is overfitted, that means you have some a priori belief of what the model should look like to begin with. That gets back to, again, some underlying fundamental economics. Generative AI is not relying on overfitting, underfitting. It's just simply fitting. It's not saying, here's what the model is and here's how we're fitting the data. It's just simply saying, here's a pattern we've discovered and it seems to add value to our portfolio. So we're going to follow blindly. And that's the hard part, blindly following what generative AI tells you to do. That's not an easy leap of faith to make. So again, when you use a term like overfitted, that means that, again, you have some initial model you're looking at, which means that you then have some initial equilibrium model that you start with, and that generative AI is either overfitting or underfitting that model. Maybe that model is no longer relevant. And that's what generative AI is saying is we don't care about models. We only care about what the data tells us and where it takes us. And that's a hard thing for us to accept. Now, I'm classically trained in finance too. I was trained in my PhD dissertation. You first have to have an equilibrium model upon which you can then build hypotheses, upon which you can then have an empirical test. AI throws that completely out the window. So this is completely anathema to my training. And so I'm having to relearn my brain at the same time.
Being curious is an important skill set, and your long curiosity. And maybe we'll leave it here, Mark. It's unfortunate we didn't get into TPA. Maybe we can do something else. You and I will be together in Old Silicon Valley in a week or so's time. But this part of the conversation is very interesting and germane to TPA because it does get to the very essence of the governance model and the board of directors and being able to put a lot of this responsibility into the hands of the CIO in their office and saying, you know what, I've hired very, very smart people, and it's up to them to figure out how to manage one bogey, which is risk, as opposed to this bucketing approach. So I think we have to be, as students of this market, prepared to relearn and not get ourselves so ingrained in the past. And you've proven that in many stations in your career. And I look forward to what you're going to continue to do at the Commonfund.
Thank you, Bill. Much appreciated. This is fun. Hope it's useful for your audience.
Absolutely will be. And I will see you in Silicon Valley in about a week.
In 1 week's time.
Excellent. Thanks, Mark.
Thank you. Have a great day.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CHI Association and subscribe to the show at CAIA.org. That's CAIA.org. See you next time.